Hello and welcome to Varn Blog. And today I'm here with entrepreneur, hedge fund manager, author, and scholar Warren Mosler, co-founder of the Center for Full Employment and Price Stability, and founder of the Mosler Automotive. And we're here to talk today about modern monetary theory, particularly as reflected in the contemporary U.S. economy. And one thing I wanted to ask you is, the Federal Reserve has seemed a little bit hard to predict, even from the standards that I normally hold it to, which is not very high. And yet, despite seeming to want to cause an unemployment crisis, it seems to be unable to do so. What do you make of the Federal Reserve's policy the last 3 years?
Yeah, let me just say, I turned over my fund management to my partners back in 1998. So I haven't done that in 26 years now. In fact, I've been out of it a lot longer than I was in it. But yeah, so it was 2022 early when the Feds decided to start increasing interest rates. And it was at that time that I pointed out that this was going to have the opposite effect of what they intended. Instead of causing unemployment to go up, it would go down. And instead of a weak economy, it would be a strong economy. And it would ultimately support higher levels of, inflation. I like to call them the inflation indicators. They're not actual inflation, but what they use for inflation indicators. And it's pretty much what happened. What they overlooked is the debt to GDP ratio in the United States. And it just used debt held by the public. The things like Social Security holdings don't matter for the economy. So the relevant debt to GDP ratio went from 35% back before the 2008 crisis to around 100% currently. And that's not a bad thing. It doesn't mean the government's going to go broke or insolvent or anything like that. But what it does mean is when they raise rates, the government, as always, has to pay more interest on the public debt. And when the public debt's that much larger, 3 times larger in relation to the economy, the effect of those rate hikes is 3 times larger, the fiscal effect of them. They increase government spending on interest 3 times as much as they used to increase government spending on interest. So with the zero rate policy, the government spending on interest eventually goes towards zero. And we went up to a 5.5% on what's now 34 trillion or so of total debt. Not all held by the public, and so you get over time roughly $1.5 trillion of interest payments because of the higher rates. Now it doesn't go there right away. Not all. Some of the debt's short term, that goes there pretty quickly. Part of its balances at the Fed, it goes there overnight. But some of it's longer term. You have to wait for it to mature, and then they pay more interest on the new debt that replaces it. However, the important point is that deficit spending for interest payments just skyrocketed as the Fed raised rates. Because the only thing that happens from the government's point of view when they raise rates, other than making an announcement, is they pay more interest on the public debt. That's operationally, that's the only change for government, is they have 34 trillion of public debt. They have to pay more interest on it when they raise rates. And that interest, there's no tax to pay for that. That's all new deficit spending. And so right now, the deficit's approaching $2 trillion this coming year, depending on what the economy does. And more than half of that's going to be interest expense. And so the higher interest rates are contributing to the deficit spending. And that's what ultimately supports a modern economy. It's your deficit spending. It supports incomes. It supports sales, growth, employment. Everything in the economies are supported by the government spending. And not to say that it's good or bad, but that is the support for better or for worse. And do too much of it, you'll get inflation for sure. But it's still what's supporting the growth. And that's what we've seen in the last 3 years. We've seen their forecasts go from recession to a worse recession as the Fed kept raising rates. And I'm saying, no, they've got it backwards. And you saw the real GDP numbers getting stronger and stronger. And instead of unemployment going up to 4.5%, 5% as they were forecasting way back, it's gone down to 50-year lows of 3.7%. We're at all-time lows in unemployment. because they're flooding the economy with money to pay the interest on the debt. And there's just no way around that. You throw kerosene on the fire burns stronger. It doesn't go out. Now, I think what the Fed's got deep in their model somewhere is the idea that nobody ever spends interest income, or very little of it ever gets spent. And so no matter how much interest income they pay, they don't count that as, they don't see that as going to have an effect on the economy. And they could have been right. They could have raised rates and the economy could have gotten worse because nobody ever spent any of the interest income they earned. But if you assume a normal rate of spending, whatever that might be historically, just by going back and looking at the data, you get what we've got. And so it should be no surprise to anybody correctly anticipating how much of the interest expense gets spent that the economy would be this strong.
This actually does kind of make sense, and it brings something that isn't often spoken about when we talk about government debt, are interest rates, because everything's assumed as payments into banks from the cost of the interest rate for the cost of debt, but no one's thinking about, well, someone's making money off of that interest. Yet, it does seem like a kind of regressive way to inject money into the economy. Am I wrong about that?
I call it obscenely regressive.
Okay.
It only goes to people who already have money in proportion to how much they have. So it's basic income payments, just like the stimulus checks, but only to people who already have money in proportion to how much they already have in order to fight inflation. I mean, this is just madness. If the people looked at it for what it was and see the Fed as an agent of government, like the military or anybody else, can decide on its own to pay over $1 trillion out of interest income only to people who already have money in proportion to how much they have, and claim that they're doing this to fight inflation, I mean, they get laughed out of the room, right? But that's what's been going on. And it's being supported by Democrats, Republicans, everyone. It's like, the Fed has to tighten up. Now, if you can explain to me how that's tightening up, fine, but it's not. And the numbers coming out show that it's not tightening up. It's drunken sailor levels of deficit spending. We're at 7% of GDP. It's boom time. This is the strongest economy we've ever had outside of a war, or immediately after a crash, you get a little bit stronger. But in terms of a mid-cycle or late cycle recovery, this is as strong as we've ever had. And they have no explanation for it except, the consumer is resilient. Well, yeah, you're flooding him with money. He's going to be resilient.
Why do you think there's such a sense of economic malaise amongst certain, let's say, middle class people right now? Because I agree. I look at the economic indicators; everything looks good. I mean, you're looking at like GDP growth. We haven't seen this consistently in a long time, and yet I also agree that it does feel like things are rougher than those numbers should indicate. And my working theory is what you're saying, that it's because this stimulus is regressive, but what other reasons might there be?
Well, there's a couple of reasons. One is, I've been looking at some of the surveys lately, like consumer confidence, and now they're starting to break them up between Democrat and Republican. Mm-hmm. And the Democrats say the economy's good, and the Republicans say it's terrible. And when they divide it among different income groups and everything else, they don't find that divergence, only when they do it politically. So it's a little bit, it's just tribal. One team wants the economy to be good to help them in the election, and the other team doesn't to help them in the election. So there's some of that going on. There's a lot of the Federal Reserve believes that things are going to get worse. If you look at their forecast, they've got unemployment up to 4.1 or 4.2% by the end of the year, in a deteriorating economy, and it's broadcast all over the news. And so it causes people to believe it. So you get surveys where people's current conditions are good, but they believe the future is going to be bleak, and it's because of all this talk. And all the professional economists for the businesses, the large businesses, small businesses, they're all forecasting weakness because of the high interest rates. Everybody's got it backwards. So they all see this meteor about to crash into the earth, and it's all doom and gloom when the sky is not falling. There is no meteor. It's the opposite. And so what you're seeing is an economy that's doing well in spite of extreme negative sentiment, which means if the sentiment just goes to normal, it's going to, the expansion is going to be that much stronger, a lot stronger.
This leads me to a kind of...
let me add one more thing to that. You have people who are very upset that the price of orange juice went up or something like that. And it has. And selective prices have gone up. And they blame, if they're on the other team, you know, if they're on the Republican team, they blame the Democrats. If they're on the Democrat team, they blame the Republicans. And it says, yeah, I'm making more money. Yeah, I'm doing well. I just bought a second car. And but, you know, the price of orange juice is up. This is really bad. So they focus on these headline price increases, and it's just human nature to do that. And there've been a lot of them that are pretty ugly, you know, that affect that they see when they go shopping. And it scares people because when you see prices going up, you're worried about whether that's going to continue. And if it does, you're not going to be able to afford to eat. And so it's a very worrisome thing to see these prices going up, even though right now you're okay. All government employees just got a 5.2% raise. They've got enough money to cover it all. But it's still an anxiety that builds up inside of you when you see prices going up all the time. And it makes you feel like you're on the edge of, you know, extinction. If you ever fell behind, you know, one false move, prices go up and you can't afford anything. So it's a very anxious time for people. And it's very uneven, of course. You've got a lot of people, even though overall the economy is helped by the high interest rates, a lot of individuals are not. And even if it's only 4 or 5%, you're talking about millions and millions of people who are hurt. So there's a lot of winners and losers. It's a very disruptive economy when they raise rates like that. The overall economy has done better. It's highly regressive, and there are a lot of winners and losers out there.
Well, one thing that you bring up that I find interesting to talk about is that many people who support the raise in interest rates, even from a kind of standard neoclassical theory of economics, which you and I both think is wrong, but even from that
inapplicable, not wrong.
Yeah. Okay. Inapplicable.
It applies to rates, yeah.
Okay. Interesting. But what I find interesting about that is, for all the current political cycle deficit hawkness, which we always see, and we see it from both parties, I think people kind of ignore that. No one talks about that every time that the Fed raises the debt rate, that the government has to pay more for that. It's just not ever factored in at all.
Yeah, the only way it's factored in is they say it's unsustainable and it means we're going to have to cut Social Security to pay for it or something. They don't look at it as new money hitting the economy and supporting it. They come up with some nonsense that doesn't apply, that's inapplicable, like cutting Social Security. And that's the direction the conversation goes. It's very misleading.
If some of these social services cuts, actually do happen, how do you see that skewing the economic trajectory, considering that I don't see interest rates going down anytime real soon?
So the main thing is the size of the public deficit, of the annual deficit spending, minus the inflation rate. Okay, so with the CPI growth down to maybe 3% and deficit spending at 7%, we've got what they call real deficit spending adjusted for inflation growing at 4%, which is very, very, very strong, and that's very supportive. If they cut that by reducing social programs, then that support for the economy starts going away. The economy becomes vulnerable. Think of that as the equity supporting the credit structure. Think of your income that supports your ability to make all your payments, your house payments, your car payments. You start cutting into the person's income, now his payments are at risk, his credit is at risk. And so for the economy as a whole, we've got, 40, 50, 60 trillion of debt and 30 trillion of equity, which is the public debt. That's our net financial assets that support everything. That's our net wealth for the economy. If you start cutting into that, it starts cutting into our ability to support the rest of the credit structure. and things can grind to a halt and go backwards. And that's exactly what happened at the end of in 2000, and that's what happened in 2008. All the crashes we've had were preceded by the public debt, the deficit, getting too small, not growing enough to support the credit structure, which then ultimately collapsed. And you can go back 200 years of American history, and it just happens every time.
So this gets me to a kind of theoretical construct of modern monetary theory that you've been kind of influential in writing about. I think the first paper I saw by you on this topic is probably around 2005, 2006, somewhere in there. And that is the argument that the natural rate of interest is probably zero. What do you mean by a natural rate of interest, and why would that be the case?
Well, there's in the sense that if there is no government interference in the financial markets, then the rate of interest is zero. A positive rate of interest requires government interference. They have to pay more interest on the public debt. Otherwise, the rate doesn't go up. This is the risk-free rate that we're talking about now, the Fed funds rate. Okay, and there's different ways for them to pay it. They can pay interest on excess reserve balances at the Fed, or they can sell treasury securities, that type of thing. If you thought enough about it, those are two ways they support the interest rate. But those are forms of government interference, is to pay interest on reserves, and they have what's called an RRP account, which is another way of paying interest on reserves, and they pay interest on the public debt. They offer treasury securities. And those two things work to those two pieces of government interference. That's the active government policy to pay interest into sell securities, is what supports the rate today, the overnight rate at 5.5%, what supports the 10-year treasury rate at 4.3%, et cetera. So without government interference, the overnight rate would go to zero, and these other rates would gravitate down to zero over time. And that's exactly how they operate. When we did have a zero rate policy, when the rate was zero, the government was paying zero on excess reserves. They weren't paying anything. So they were not interfering, and the rate went to zero. Japan's had a zero rate policy for 30 years by not interfering in the marketplace. So the natural rate, in the sense that where interest rates go, if the government doesn't interfere, is zero. And all the money and banking textbooks understand that. They show the Fed's job is to offset operating factors, which is to take an active part to support the target rate set by policy. And when you hear the term financial repression, they're saying that's assuming there's some kind of natural rate like 5, and the government's taking action to push it down to zero or to push it lower than that. And they call that financial repression. It's completely inapplicable to today's floating exchange rate system. That would be true under a gold standard where there's a limited supply of gold. People compete for it and bid for it and bid to borrow the gold. And their desire might drive the rate to borrow gold up to 5%. And if the government wanted it lower, it would have to come in and suppress that rate by taking action. But that's been gone since 1934. And you'll still see the media talking about financial repression, keeping rates below some kind of natural rate, which is a fixed exchange rate phenomenon. It's got nothing to do with today's floating exchange rate policies of almost every country in the world. The only place that would be true would be like Hong Kong and Bulgaria, maybe, or something like that. Some very small places that have fixed exchange rates or dollarized. Maybe Panama's dollarized, I think. So it might be applicable there. But the rest of the world is entirely inapplicable. And it's a disgrace that these economists would even say that. I mean, how can they not know that? It's basic, economics 101 stuff. It's pretty bad that stuff is in the mainstream narrative.
This does lead me to some larger questions about the global economy. There's been a lot of talk, both on the mid to far left and on the far right, although for different reasons, about de-dollarization. On the far right, and you see this in a weird plank I saw on the whole project 2025 that the Heritage Foundation was putting together for the Trump administration, where they are trying to pick back up something I thought that even the weird grifting libertarians give up on, which is because of de-dollarization wanting the United States. That's their justification. It just seems to be this weird pet theory that they have, that we should go back to a gold standard. I'm not sure if they're talking about the pseudo gold standard of Bretton Woods or an actual gold standard of, before 1934, but nonetheless, that seems to be back on their political horizon. And
let's just say that's out of ignorance of monetary operations.
Okay.
People come up with these things that, I had a car company and I used to have people come in once a month with some kind of perpetual motion machine, it just doesn't work that way.
And on the far left, there's been a lot of predictions of U.S. dollar collapse because of it not being as much of a forex currency, which the latter's been kind of greatly overstated, how the replacement of the U.S. dollar as a foreign exchange currency, but B, you seem to think that's not as important as they do.
I mean, I've been hearing it for 50 years, along with how, Reagan saying if the deficit ever gets to 90 billion, we're all doomed. This stuff's been going on for a long time. That's part of the fear mongering over nothing that just gets dusted off and revved up and revised, every 3 or 4 years, it seems.
Why do you think that it's both a left and a right-wing phenomenon right now?
That's a good question. You have to blame mainstream economics for not teaching this stuff properly in school, and just having just a pathetic level of economics education. So I have to give you a quick anecdote. I went to the University of Connecticut. I got a call years later from the donor department, whatever that is. The guy's looking for money to support this school. And I said, well, they're teaching money and banking wrong. And, if they'd agree to teach it correctly, I'd be happy to make a donation. He goes, really? No, he was just he wasn't an academic. So he sets me up with the head of the economics department. And the three of us sit down and I say, you're teaching that banks take in deposits so they have the money to make loans. And in fact, loans create deposits, and then the banks have to take in money to replace those deposits if they leave. But the money comes from any bank purchase creates a deposit. The bank credits the account. And the guy says, and it was a woman actually, but whatever, says, yes, you're absolutely right. That's how it is. That's how it does work. And yes, we are teaching it wrong. And so the guy who's looking for my donation says, what, would you be willing to change it and teach it the correct way? And he says, no, we're not going to do that. And he was just looked aghast at this person, like, what? I don't think he believed me when I told him that was the reason I didn't want to donate. And he's just like, he was just bewildered. We left the meetings. He goes like, sorry to bring you in here. He didn't know what he got himself into. And I think that's indicative of what's going on everywhere. From what I've seen, I haven't seen a single mainstream academic, and probably very few of the post-Keynesians who get any of this stuff right. And occasionally some of them will get bits and pieces correct, but the basic level of education is just incorrect. Now, when I go into the Fed and talk to their operations people in monetary affairs, they know all this cold. It's what they do every day. They know what accounts get debited and credited because that's what they do. They know how to offset operating factors and do all the other things it takes to sustain a monetary system. But you go to the academics, it's just abject ignorance of what's going on.
Yeah, that leads me to, a couple of things that have kind of bothered me about the way the discussion of economics has gone. One of the things I have noticed is a lot of the post-Keynesians, including ones that I was always a little suspect of, but I thought were closer to right, such as Paul Krugman, really regressing.
He's a new Keynesian, by the way.
Yeah, new Keynesian, yes. Yeah, but new Keynesian, to explain what we mean by that, is they took out the stuff about taxation and replaced it with monetarism, more or less.
You're being kind, but that's okay.
But I've also noticed, like, let me think of an actual post-Keynesian, like Steve Keen and whatnot, also being not as up on this as I would expect them to be from what they said, I don't know, 10 years ago. What do you think about the state of, quote, heterodox economics right now? And then it's like more mainstream, I'm putting all those in quotes, sisters in like new Keynesianism and more academically respectable post-Keynesianism. Why does it also seem to not be as much of a help as maybe it was a decade ago?
So at the highest levels, your new Keynesian and your, that's what the Federal Reserve is. It's been modified a little bit, but that's where it all started. And the idea was that the reason markets don't find equilibrium is because of sticky prices, which is absolutely not what Keynes said. Keynes pointed to a lack of effective demand. It had nothing to do with sticky prices. But anyway, that was their thing, and they have all their mathematical models surrounding it, none of which have money in them. And the core problem is, it's going to get a little bit technical, they don't have any understanding of the source of the price level. They started with this thing called the fiscal theory of the price level, but they couldn't get the math to work on it, so they've kind of abandoned it. These are top guys, very astute academics like Michael Woodford and that whole group, and they just couldn't get it to work, and so they've kind of abandoned it, and sometimes they fall back on it. They were getting pretty close. So what they've left out, and what Keynes also left out, and Marx and the rest of them, is the understanding that the currency itself is a case of a monopoly. The government's the single supplier of that which it demands to pay taxes, for payment of taxes, and to buy its bonds. Okay, you can't go out and print your own money to pay taxes. That's called counterfeiting. Okay, so all the dollars to pay taxes come from the government through its agents. And then people start arguing with me, like, I won't mention names, there's too many of them. Well, that's not true. It all comes from the banks. It's like the banks are agents of the government, and they're registered, they're licensed, they have accounts at the Fed that are used to pay taxes. You can't use their regular accounts on their banks. They have to use their Fed account. And they're regulated very strictly by the government. They regulates it's called CAMELS, C-A-M-E-L-S. The capital, their assets. There's a big thick book on loans they're allowed to make and not allowed to make, and they get regulated and supervised to make sure they're only lending money, that they're in compliance with all the federal rules, which are changing all the time with every crisis, telling the banks what to do. They can change bank management anytime they want. If they don't like the bank's earnings, they can shut them down. If they don't like their liquidity, they can shut them down. If they think they're taking interest rate risk, the regulators can shut them down. I was an owner of a bank, very small bank for about 20 years. And I knew I was an agent of government, that those guys were on us all the time, watching everything we're doing, classifying loans, which means if they didn't like something you did, it didn't count. They counted as if you'd lost all the money for regulatory purposes, and we're always on the verge of trying to put you out of business. So you had to, if they said jump, you said how high. And so the banks, from my working knowledge, is that they are agents of the government, the same way the military is an agent of the government. Yes, if you're a platoon leader, you have discretion on where you can march or where you can point your guns or how many shots you can take, but you're not independent of the military. You are an agent of the military, you're an agent of the government. And so all the dollars to pay tax that can be used to pay taxes come from the government through its agents. Congressmen don't spend directly. They have agents out there like the Fed and the Treasury and Post Office, whatever. So it's a case of monopoly. There's a single supplier. And everyone knows from Micro 101 that single suppliers are price setters. You get to set the price. If you've got the electricity monopoly in the city, you set the price, 15 cents a kilowatt. Now, it may have terrible consequences, but that price will stay there till your committee gets together and changes it. It doesn't come from the market bidding for electricity or anything. Now, they've tried to implement things like that, and they've had, I won't comment on the results. Some have been absolutely horrendous, and they don't, deep down, they're they're better off just setting the price. But anyway, they're trying to break up the monopolies and make them competitive. But when you have a monopoly, you've got a single supplier, you've got a price setter. To not have a price setter, you've got to bring in competition and everything else. Well, the government is the single supplier of the funds to pay taxes. There's no competition there, and that is the source of the price level. Now, markets can sort out what's called relative value. How many ounces of gold how many ounces of silver does it exchanges for 1 ounce of gold, or how many gallons of gasoline exchanges for a bushel of corn? That's what our markets do all day long. They show you relative value. The peaches die, so the price of peaches goes up, which means that's the markets allocating by price, determining that the relative value of peaches has increased because peaches died or something like that. But to put a price tag on those things, if there was, if I came up with a new currency in a new country, and we'd say, okay, how many peaches? What's the price of peaches? What's the price of labor? What's the price? There's no way to determine that. You've got kids in Turkey. You go to buy a rug, and they'll tell you in every currency in the world how much it costs. But if you've got a new currency that they don't know about, they don't have any way to figure this out. Okay, there has to be some information in those markets about that currency so they can get started. They have to have some price to get started with, and that's called the source of the price level. It's called absolute value, and so that comes only from the monopolist. He has to tell you. So when the government's hiring soldiers at $50,000 a year, they're saying you have to work a year as a soldier to get $50,000 of our currency that you need to pay the tax. If you work as a Supreme Court judge, you get $200,000 a year. If you work in the post office, you get $40,000. Whatever it is. The government has to let us know what we have to do to get their money, so we then have that information to know what everything else should cost. And the markets can't get that information from anywhere else except the government. If the government stops giving that information, the markets stop trading in that currency, which happens when a government fails or goes away or whatever. It just ceases to do it. And when you get a new government starting, you don't get any. Nobody knew what a euro was going to be worth 5 years before there was a euro. So how did they know when the euro started how anything would be worth? Because they announced that they were going to buy the existing currencies at a fixed exchange rate. They announced the exchange rate so everybody knew, could put their finger on how many lira you needed to get a euro, how many marks you needed to get a euro, how many francs you needed to get a euro. And so that translated into all the other prices. The new government, the new central bank, the European Central Bank, bought the existing, let's call it money supply, at announced prices, and that got price level started. Well, the mainstream doesn't understand that. They don't know where the price level comes from. What they do is when they assume a price level in their models, they just take yesterday's closing prices, and then they can start to tell you how they think they're going to change. Oh, we're doing this and that. We think those prices will go up, or we think those prices will go sideways or go down. But they don't know where they came from, except they were yesterday's prices. If you ask them, well, where did those come from? They say, well, from the day before. Where'd those come from? The day before. It's an infinite regression all the way back. And they'll tell you, we don't have a source of the price level. The best we can do is use yesterday's close as a starting point. And anytime you interview a mainstream economist, ask them about the source of the price level. They'll tell you that. Okay. Once you understand that it comes from the government, because they're the single supplier, then all this other stuff that they struggle with is easy and falls into place. And so they have yet to model the currency, the dollar, as a U.S. government monopoly, the euro as a monopoly of the European Central Bank and the European Parliament, the yen as a monopoly of the Japanese government. They have yet to do that. Now, interestingly, Keynes described the currency the way you would describe a monopoly, but he didn't call it that. And I'll say he never realized that he was describing a monopoly. So he was right in his description. It doesn't grow on trees, he can have shortages because the government's not spending enough. He surrounded it and got all that stuff right, but he never called it a monopoly. And when he was arguing with mainstream economists at the time, they called them neoclassicals now, I don't know what they call them now, they would tell Keynes, no, you in the absence of a monopoly, without a monopoly, unless there's monopolies, you're not going to have unemployment. Unemployment is caused by a monopoly. Keynes would say, no, you can have unemployment because of what's going on in the monetary system. And he was correct. But what was going on in the monetary system was a monopoly. Now, if he knew that's what it was specifically, he would have said to it, he would have answered that way, but he didn't. And I don't want to get too far out in the weeds here with your questions. But once it's clear that currency is a monopoly, then you realize the source of the price level, and then you realize that the sequence, which is the big contribution from M&T, that the mainstream economists have is backwards. They all assume the government has to get money to be able to spend. The U.S. government has to get dollars to be able to spend. So it has to tax or borrow to be able to spend. That's not true at all. It's the economy has to get the government's money to be able to pay taxes and buy bonds. It's not the other way around. The dollars come from the government. And when they believe the opposite, it leads to all this nonsense that's going on. Jamie Dimon talking about how the public debt at 34 trillion is unsustainable, just a matter of time. Jerome Powell, same thing. Moynihan, same thing. Your top 3 bankers in the world, really, all got this like pathetically wrong. And they're public about it. And, they're getting publicity about it. And the people in Fed monetary operations know this is absurd. It's completely inapplicable to our system. It's like, and they're watching these people do it. And here it's been going on, for my 50 years that I've been watching it.
Well, there's an chartalism and neo-chartalism both have some interesting implications about tax policy. And I think you've kind of explored this in a different way than even some other modern monetary theorists. Like your ideas on taxes seem to be a little bit different from, like, say, Stephanie Kelton's. I wasn't actually planning to bring this up, but I might as well. What would you think would be an optimal tax structure to anchor the currency in the United States that would not be like super regressive? And has your thought on this changed over the last 20 years?
It's right back in soft currency economics from 1993. It's 3 years before this was introduced to the academics. And I think just a property tax, real estate tax like we have at the local level now, if that was a single federal tax, it might be high, like 10% or something. And combined with a job guarantee. So if you lose your job, you can always get paid in a job guarantee. So you're not going to get thrown out of your house, out in the streets because you lose your job. And I understand that there are a lot of people who can't work or disabled, and that all has to be taken care of course, the same way we do now. Then that would enhance the standard of living of the lowest income groups, let's say the 50%, the lower 50% of income groups, by probably 100%. The real standard of living would go up by probably 100%. And without connecting all the dots in this, I can if you want, but it answers your question of why I'm behind it. And so to me, the outcome is as progressive as you can imagine, where the real wealth would go there and you wouldn't be taking anything away from the higher income groups. You'd just be enhancing the real GDP, which would go up by 25 or 30%. And most of that would, if it was in the correct public services, public education, public health, infrastructure, would disproportionately benefit the lower income groups, because the higher income groups have their own infrastructure, right? And so that's how I would do that. That's how my proposals all aim to do that. And at the same time, it gets rid of vast swaths of the financial sector. And one of the channels that I really hadn't talked about, but I should, is that when you go to property tax, and you eliminate income tax, you've eliminated massive incentives to save, to not spend your income. The incentive to put money in your 401k instead of to have it to not do that and to not spend it is because it's pre-tax. Well, if that tax is gone, then that incentive is gone. The incentive to put in a pension fund is there because it's all pre-tax. All the reserves that insurance companies and banks will pile up when they can is all because it's pre-tax. So if you don't have those taxes, there's no incentive to do that. And so the pool of funds that would be managed out there, which is, 40 or 50 trillion, would be way down. maybe down 90%. So you're eliminating like 90% of the financial sector by doing this, and which is a massive ancillary benefit. All those people are the brightest and best. They'd be out curing cancer, and educating, and doing research into who knows what, or in software and everything else, and improving our lives instead of digging holes and filling them in, which is what the financial sector is. It's just largely predatory that lives off the institutional structure set up by Congress, which includes all these savings desires. So I'm not blaming these people or demonizing them. It's not their fault. Congress has set up this structure that rewards them dramatically for compliance, for being part of it.
So just predicting a counter argument that you normally get, would not that decrease investment in productive capital, quote unquote?
No, I don't know.
To remove the savings sector.
I don't know how you connect those dots, because and it's chapter 6 of my 7 Deadly Innocent Frauds, which is free online. Just click on it, moslereconomics.com, or on my Twitter account at WB Mosler. But savings is the accounting record of investment. It's not the stuff that gets invested. And all the old mainstream textbooks had that. And now it's become counterintuitive, and somehow all these congressmen are convinced that you need savings to have money for investment. And it's completely backwards, and all that does is feed the financial sector. And so it's surprise, surprise, that's what they're pushing, right? And it's intuitive for people to understand, you need savings to have money for investment, so let's do this. We need this huge financial sector to have investments. It's completely not true. In fact, it's the reverse. The financial sector uses up real resources that would otherwise be contributing to real investment, and not, nothing to. So that's where the financial side is actually interfering with the real economy.
I guess this is kind of harkening back to something we mentioned almost 20 minutes ago, but you were talking about the economies that do have actual monetary constraints because they're explicitly legally pegged to the dollar. Where this has seemed to be the most, to put it, I mean, just directly, the most unstable fiasco is Argentina. And currently the right-wing government seems to be big on another dollarization scam to cut down on their inflation, etc. What do you think is likely to happen?
I don't know. When the guy with the chainsaw talks, you listen, right? He actually campaigned to change. That's how bad things got, or how unhappy people were, and with the current system. And that's what happens. Now, the easiest way to understand that is, let's say you were going to start a bus company, and you were going to charge $2 for a ride, and you were going to use bus tokens, so people could buy tokens and then use them to ride the bus. And so you had two choices. You could either make up your own bus tokens, which might cost you a penny a piece, right? Because they're cheap metal, whatever, and maybe it cost you a nickel. Or you could go to the bus company in Europe that's already is operating and selling bus tokens for $2, and buy their tokens for $2 each to use at your bus company. Okay, so let's say you had two bus companies, one on the East Coast and one on the West Coast. No, I don't want to polarize myself that way. Two hypothetical bus companies, one in country A, one in country B, so I don't alienate anybody. And one bus company buys their own tokens for $2 a piece from some other bus company in another country, and the other one just makes their own. Which one's going to do better financially? Like, it's a burden to have to take your profits and buy these tokens for $2, right? Versus the other bus company that's just making them out of copper or something, tin or zinc, or I don't know what's cheap nowadays, lithium, and using them as their bus tokens, creating them for 5 cents each and using them as bus tokens. Why would you go out and buy bus tokens from somewhere else? Say, well, that way the bus token has intrinsic value and people, will buy them, don't have to worry if they buy them to ride the bus, because they'll be, they could always sell them for them, use them in another country or something. I don't know. So like a ridiculous argument. Nobody would ever do that. Yet that's what Argentina's doing. They can create their own pesos, or they can buy them from the U.S. for $1 a piece, and they have to use real exports to get those dollars. So they have to use their real output, their real labor, sweat off their back to export to the U.S. to buy our dollars, to get our dollars, just to have their money supply, their money in pension funds, their money in the banks, their net financial assets have to come from net exports. Why would you do that when you can get your net financial assets for free? So, but that's what they're doing. And every time anybody does it, their real wealth is being diminished by the cost of those net financial assets, whether they know it or not. And they never measure success by that. And there's a guy named Steve Hanke at Johns Hopkins, I think, who's been advocating currency boards. I talked to him about 10 or 15 years ago about this because he was advocating a currency board where they accumulate reserves. It's kind of like dollarization. And I said, yeah, you get price stability, but you lose, it's costing you like 5% of your real wealth every year to fund your net financial assets. He goes, yeah, I know. He says, but I think it's worth it to have price stability. It's like, okay. He didn't disagree with this. He just thinks it's a good trade-off. But why would you trade off even 1%? It's like madness, I think. And it caters to a misunderstanding or an illusion or something. Nostalgia, I don't know. It works politically, but it's just a heavy cost on the economy. So it's not that it can't work. It's just that it's always a heavy cost on the real standard of living.
Which always makes it interesting to me when non-rich countries try it, because, okay, let's say you're Hong Kong, or even the U.S. would never do it, but let's say you're the U.S. We have the real wealth that we could theoretically eat some of that for price stability, right? But Argentina doesn't.
Why would anybody do that? It's not that. Once you understand, how a non-convertible currency works, price stability is no more difficult. It's just as easy. Once you understand the source of the price level and the whole thing, you can sustain full employment. You can sustain. Look, your real wealth is your domestic output plus whatever you import minus what you export, and most of it's domestic. So you can sustain full employment to maximize your domestic, real wealth, and work your real terms of trade so you maximize those. It's not hard to do once you understand what you're doing and what the target is, but they don't. They just don't do it. The countries that are the poorer countries are the ones that don't have full employment. It's pretty hard to pick a country that's not, not a top tier country that has high levels of employment. They don't. The reason they're emerging or developing or whatever polite name you want to give them is because they've got staggering levels of unemployment for the most part.
So it seems like, what you're arguing is also the refrain that I might see to this argument as well. Argentinians have to buy things outside of Argentina. And you're arguing, yeah, you realize that, but you need to get your domestic economy up to top production first, and then you'll actually.
Wait a minute. You say can't buy things outside of Argentina?
Or they need to. They need to buy things outside of Argentina.
Okay, but look, if you look at every one of these countries, and you look at what problem's been identified by the IMF or anybody else, they're importing too much. So they're importing too much, and then you say, well, what's the problem with this? Well, we won't be able to import. Well, you don't have that problem. You're telling me your problem is you're importing too much, and you want to do this because, what are you talking about? Any country running a trade, they're all running trade deficits, right? So, and they're all trying to get to balanced trade, which is to import less. And it's not that I'm saying they should do that, of course, but they're just talking out of both sides of their mouths when they ask these questions. They don't realize what they're saying. It's all contradictory. Which it has to be if you're fundamentally wrong, right?
Yeah. Well, I mean, it is interesting to me when you're talking about a country pegging its money to the dollar, which would only make sense if you need to buy things from the United States to also decrease your trade deficit.
But they're already doing that, even with 200% inflation.
Right.
They're already importing all they wanted from anywhere, and they were trying to reduce it as a policy. because the United States and everybody else wanted to sell and was selling them more than more than the government wanted people to buy. So they're working to reduce that as a policy. And then you're saying, well, the problem here is you would do this only if you want to buy from the U.S. You see how they're like talking out of both sides of their mouths when they're making these statements? Yeah, they're just empty headline rhetoric. And that's what rules the day and gets you elected, I guess.
Because it makes sense that in any economy, even in a highly globalized one, still the majority of financial transactions with the country are within the country. And so
even if they're not, you can go to the poorest country in Africa and buy gas for your car, and you pay for it in local currency.
That's true.
How does that happen? Because the markets figure that out. Okay, you don't need the government for that. Okay, there's an exchange rate and it figures it out. Maybe the price is more than most people can afford, but whatever. It's not that you can't use your currency to buy imports. Every import in the world is available for sale in every country, at a price. And maybe the price goes up in local currency every day like Argentina was, but it's there. And somebody's buying them in very large quantities. You got huge boats bringing them in every day. So, and the government's trying to reduce it, not increase it. It's not like, we haven't been able to import because of the inflation. Let's dollarize so we can import more. That's not what they're thinking.
This does lead me to a different but related problem. Another country that seems to be dead set on destroying its internal domestic economy. And I might get to a third one, but here I'm talking about Britain. Which has seen dramatic economic declines recently. In fact, I make a bitter joke that it really wants to be Argentina, but it is not dollarizing. So what's going on there from your perspective?
Well, the budget deficit's too small, right? So the real deficit after inflation is pretty close to zero. Last I checked. I haven't looked at it recently. I don't follow them, like on a day-to-day basis or anything. And that's pretty much it. They've got this idea that, I guess, going back to Thatcher, is who popularized it, at least, and it started before that, about, you eventually run out of other people's money and they don't understand. They've got the sequence backwards. And there's no telling them about it. And until they understand that right way around, until they understand the source of the price level, and so they can make decisions on the price level, on inflation, based on what actually causes it to go up and down. After which they might decide they want a 5% inflation rate, but at least they'll know what it is and won't be afraid of it and won't be fighting it with austerity. Until they gain that understanding, they're just going to wallow, in the mud over there. I think I don't see much of a way out if they're going to keep themselves in a fiscal straitjacket.
I guess this also leads me to the last question, which is, I actually am having trouble understanding exactly what kind of financial shenanigans are going on in Turkey. So, what do you think is happening there?
So it depends on, let me take a view that somebody might consider cynical or practical or something. When you have high rates of inflation and you've got high levels of output and relatively low levels of unemployment, so who gets the real wealth? Now in the US, we're paying interest, so it's going to the higher income earners, right? So in Turkey, what they do is they have their wages of the lowest income earners are indexed. Government sets the minimum wage that affects most, like 50% of the workers or something, workforce. And they continually increase that to make sure that 50% of the workforce is doing reasonably well, no matter what the value of the currency is. They just give them more of it. And if that causes more inflation, they'll give them more of it. All right. And that keeps 50% of the people relatively pleased with what's going on, relatively secure. The other 50% have to scramble to stay where they are, but they're, doing better anyway. And those 50% support the leadership. who is taking care of them. So that's a constituency that supports the leadership. Now, I haven't taken any surveys or looked to it. I'm just reading the headlines. I don't follow Turkey at all. But I'm just tossing that out as something to look for. You've got lots of state-owned enterprises. You've got lots of foreign companies that are, exporters, right? And the inflation is not getting in the way of any of that. It's making it easier for them to do that. It's making it easier to have real wages not run away, so that the exporters can do well with their exports. It keeps their costs down. At the same time, the wages are high enough for that group of people working there to keep them happy and to keep them ahead of the curve in terms of the inflation that's going on. And it seems to be working, and it's kept the leadership in power for quite a while, and it's kept them reasonably popular in spite of everything else that you see, all the headline things that people talk about that you would think would make them unpopular. But keeping that 50% whole is like wielding political power, and it's supporting, their longevity in office. Now, in Argentina, it obviously ran out, and they got it, turned over. So they were not keeping a constituency happy enough to keep them getting reelected.
Yeah, that makes sense. Well, we're coming into election year, and this will be my final question, but I think we're going to see a lot of economic claim shenanigans, do we see a lot of fiscal changes from the government on the horizon? Are monetary changes? Are both? Like, what do you think might happen? I know we talked about the Project 2025 thing. I tend to believe that when conservatives talk about the gold standard, they will quickly be corrected and not do anything about it, because that's always what's happened in the past. But are there other possible big changes you see on the horizon?
I don't see. I see interest rates staying up, and I see the deficit staying at what I call drunken sailor levels of spending to keep the economy going, and some effort to talk about lowering it, but nobody actually doing anything. And what's happened is, as the inflation indicators have come down from the COVID highs, post-COVID highs, the Fed has been concerned that means their 5.5% Fed funds rate it's a higher real what they call real rate. It's above the inflation rate. So if it's the inflation rate is 3 and they're at 5.5, they're 2.5 over the inflation rate, which they think is highly restrictive. But what they haven't taken into account is that a 7% budget deficit, it is also much higher in real terms as the inflation indicators come down. So if it's at 3 and the deficit's at 7, we have a 4% deficit after inflation, which is very high. And it's record high for this point in the business cycle over our history as a nation. Our strongest business cycle has never had this much fiscal support. So it's, I think it keeps going. If anything, Fed starts looking at raising rates like they have been now that this pause, to see if inflation would come down, seems to be reversing. Now, I could be wrong. If price of oil suddenly drops and the CPI numbers come down, then the Fed might decide to lower rates or something. On the other hand, if it goes up and they start shooting up, then they could start to raise rates more quickly. More often than not, at this point in the cycle, it's things like that cause the next move. And you can have somebody forecasting things based on all these models, but the models can't tell you whether oil is going to go to 200 or to 20. That's the Saudis are price setters, and they're deciding what to do on that. And it's just a couple of people. So, we're all our forecasts are at risk of that. But things staying the way they are now, I just see this economy getting stronger and stronger. Unemployment staying at 3.7, or maybe even going down to 3.6, 3.5, 3.4. And the Fed keep revising their forecast for the second half of this year ever higher, as they did in December. In March, there's another meeting. They'll revise them higher. The rate cuts were there as a consequence of the rest of the forecast. The rest of the Fed's forecasts showed unemployment going to maybe 4.2%, growth going to 1% or less. Jobs growth down to under 100,000. As those get revised up, like they did last time, now the unemployment number may be only 4.1, and then you see their forecast for the interest rate are a little bit higher than they were before. So with a very negative forecast, their forecast for the interest rate were maybe coming down to 3.5%. And now with a stronger forecast, their forecast for the interest rate is maybe 4.5%. And the market shows that as fewer cuts. The market had anticipated 6 cuts. Now it's anticipating maybe 2 or 3 cuts or something like that. And so as the Fed's forecast gets revised higher, the interest rate forecast for that period of time will get revised higher, I believe. And so I think we'll just see, and then once it's strong enough, then they'll be looking at whether or not rates need to go higher, because that's all they know. They've got it backwards. They're not going to change that, I don't think. If they do, it'd be wonderful if we suddenly had some kind of serendipity thing, and all of a sudden Chairman Powell says, we've realized we've been backwards on interest rates this whole time. Raising rates has been inflationary because we're pumping in all this deficit spending. It's obscenely regressive. We're immediately reversing policy, going to a 0% rate like Japan, and we expect inflation to come down. Wonderful. I stand up and cheer, but I don't expect that.
I'm guessing you're also not seeing any like other progressive economic policies coming out of Congress either. So
I don't think they can get any policy out. They can't even get a border policy, the Republican border policy passed that the Democrats agree on, because of the divisiveness over the election. It's just pure tribalism, and their people vote for want their team to win, and the means justify the ends. And it's just, a race to the bottom to how low they will go to get there.
I mean, for me, this has been an irony for a while that people talk about American decline, and I'm like, well, in one sense, I think that's almost. There's a lot of things declining because we don't invest in infrastructure. Like, that's all very real, but it's not because we don't have the material wealth to do so. I'm not even talking about paper wealth. I'm just talking about, like, we have land, we have materials, we have farmland, etc. We're in a remarkably good geographic area with good trade partners to the north and to the south of us. We should not be having the problems that we do. And if we have problems in the United States, it's because our political system has just cracked for whatever reason. I have my theories, but it does seem like our real crisis is not, well, in some ways, all economic crises are political crises, but in a very real sense, it seems that our, even beyond what that would normally mean, our crisis is a political crisis. We can't get pretty much anything through our own government, even when it's backed by the party and ostensibly in power, although there's not one right now.
And look, don't forget, things are heating up in real terms, the climate, and forget about who caused it or why. Nothing's going to be done about it except trying to deal with it. Better air conditioning and walls around Miami or something, so it's going to be interesting to watch how we deal with all this change in the real world.
Yeah, it's
massive migrations, all that stuff. It's all going to happen. We're not going to do anything to prevent it. We're just going to have to deal with it.
Yeah, absolutely. I've been thinking about the weirdness of our border policy when also we have a declining population rate, and it seems to be both sides have decided that we're not particularly open to immigration, and I get it, but I'm like, you're about to be hit by a wall of people from the equator, because the equator's getting real hot. Also, just interesting. I mean,
we'll be raiding. We'll have military raids on Mexico to bring back workers.
Yeah, it's just
around the corner. Okay, very good. I've got a 12:30.
Thank you so much.
And just send me a link whenever you can.
I will do.
I'll spread it around for you.
All right.
Great talking to you. Anytime, let me know.
All right. Thank you, and I'll send you the link.
Thanks. Yeah. Bye-bye.